Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Welcome to the Global View on this Wednesday. Well, let's take a look at the macro picture to begin with. And longer-dated US Treasury yields have eased after the benchmark 10-year note reached close to a 16-year high, supported by the prospect that the Federal Reserve will keep interest rates higher for longer and government fiscal deficit will widen. Real yields, as seen in the 10-year inflation-protected Treasuries or TIPS, have climbed almost 40 basis points so far this month. The 10-year yield was at 4.33% and the 2-year rising above 5%. Meanwhile, Richmond Fed President Thomas Barkin has said the Fed must be open to the possibility that the economy will begin to re-accelerate rather than slow, with potential implications for the US central bank's inflation fight, saying it doesn't strike me that having a 10-year rate over 4% is somehow wildly inappropriate. And the US dollar has edged higher against most major currencies, nearing a 2-month peak ahead of the Jackson Hole Symposium later this week. And traders also watching an emerging economy summit in Johannesburg of BRICS nations, Brazil, Russia, India, China and South Africa, particularly for news on Chinese stimulus. China's leader Xi Jinping told the summit that China's economy is resilient and that the fundamentals for its long-term growth remain unchanged. Checking in on the Aussie dollar, currently trading just shy of 64.2 US cents. All right, well, given what's going on, particularly with those bond yields at the moment, let's check in with Talaria co-CIO Chad Padowitz, who joins us now. Chad, good to catch up with you. So I'm just talking there about where those Treasury yields are going at the moment. What are your observations about what's actually driving that?
Yeah, well, obviously, as I think you mentioned, the US Treasury, the US deficits continue to expand, and it's been quite negative for many years, and it's going to go to approximately 2 trillion. So there's a consistent requirement to issue bonds, and I think not everybody wants to own US Treasuries given inflation's quite high. So the real rate of return is actually quite negative in many respects. So the yield has to keep going up to entice buyers. So it's really a function of persistent sticky inflation and the requirement to constantly issue treasuries.
Well, so who is buying them at the moment then? Because I see you note that essentially those foreign central banks are not particularly enticed by it at the moment.
Yeah, broadly speaking, it's been domestic households and obviously some institutions within the US, savings, insurance, banks. But bear in mind, the regional banking crisis we had a couple of months ago, a large part of that was brought about that some banks had actually bought long-dated US Treasuries that then declined in value and created a solvency and a bank run effectively. So the desire from that part of the market to own long-term Treasuries has probably also decreased. So there is some mix going on, but the net result is when you do have to issue, $1 to $2 trillion a year of new debt, you constantly are fighting to find incremental buyers of that. And if any one or two major parties step away, that in and of itself will create a yield issue.
Yeah, and of course this also brings into focus that equity risk premium and what's going on there at the moment.
Yeah, well, so while the bond market or bond prices and yields, the yields are going up and bond prices are going down, so it's been a pretty bad time to be a fixed income investor. The equity market has, at least up till now, broadly traded quite differently to that. And whether that's because people are looking to find inflation hedges or certain segments of the market like the Magnificent Seven and the Nvidia type AI type companies are taking a lot of are getting a lot of strength and are helping the broader index up. But there is ultimately we think they are linked. Higher interest rates does impact the discount rate. It does impact the growth rate. and it does impact the financing rate of companies. So all of those things should, in our view, lead to a lower equity return going forward. But as of now, the equity market, at least at the index level, there is some level of disconnect already happening.
So, Chad, what are you observing more broadly, I guess, with the global economy in terms of the data that we're seeing at the moment, particularly with, I guess, those purchase and managing index or the indices there? And well, let's first start there, and then perhaps what you're seeing right now in the States.
Yeah, so the leading economic indicators, of which PMI is one, are quite negative, and effectively around 80% of countries have a PMI below 50, which is obviously signaling a recession to come. It's quite rare for that to happen during a tightening cycle. Usually that would happen already, rates might be on the way down. So you've got a tightening cycle alongside a leading economic indicator saying that things are going to get worse. So I think it's definitely a time to be quite prudent in terms of where one expects the economy to go, jobless rates to go, and obviously equity markets as well to go.
All right. Well, with that in mind, then, how do you adjust your portfolio as a result?
Yeah, so I mean, our view is, in light of these challenges of both valuation of interest rates, inflation, and the economic growth momentum to come, we think one should be, have companies that or sectors that have lower economic exposure, less affected by those dynamics. So healthcare as an example. So healthcare companies they substantially always offer defensive characteristics because they're not overly impacted by the economy, inflation, but they're not always attractively priced, but they are currently attractively priced. So you do get the unique combined aspects of attractive valuation, and those valuations at the global pharmaceutical, that's the sort of sector we think what I'm referring to now, those trade on around 7 to 8% free cash flow yield with very good balance sheets and very defensive earnings. So you have low economic sensitivity, defensive nature, which should do well in an economic equity market downturn, and you have the valuation support as well. So that's certainly a sector that we think is attractive at the moment.
Where particularly are you focused then? If you're looking at healthcare for opportunities, then you mentioned those global pharmaceutical companies. So are you concentrated on the big end then?
Yeah, we would be on the larger end, the global pharmaceuticals, as you mentioned. So one of them, for instance, Roche, which is a Swiss-based pharmaceutical, giant. They make about 20 billion profit a year. They trade on market cap of just over 200 billion. And you can buy that on around 12 times earnings now, and that's after spending a substantial amount, 10 in the vicinity of $10 billion of R&D every year. So they don't have much patent risk over the next decade, and you've got all this R&D which you're getting at a substantial discount and around an 8% free cash flow yield as well. So that's that would be one of the shares that we quite like at the current price. Other ones like that are Sanofi, Novartis, Johnson & Johnson, Gilead. Those are all in our portfolio.
All right, and I'm imagining then perhaps you're going to steer clear of some of those COVID winners, particularly the likes of Moderna, which are suffering given, well, the world's essentially moved on, hasn't it?
Yes, it has. Now we have a bottom-up process, and shares come through that, and Moderna just hasn't. So I can't overly comment. We haven't done any detailed work on that because it hasn't come through our screens or our process. But yeah, if we are looking, generally speaking, for companies that have sustainable long-term earnings and growth in those earnings as well. But they, something that is more short-term nature, that is peaks and then troughs quite quickly. That is something that we would be far more hesitant in.
Chad, just to round it out and back refocusing on the US economy, and I see you're pointing out that you harbor some concerns there just in regards to property valuations, I guess as matched with the capacity of Americans to buy a house at the moment.
Yeah, I mean, the housing market has remained quite strong in the US, notwithstanding higher interest rates. And, partly that's because if you've locked in, a few years ago, call it a 2% 30-year mortgage, the inability of you to move that to another house where you have to pay 7 or 8% now means you're not going to sell where otherwise potentially you would. So there is a significant reduction in supply, so volumes are quite low. But in terms of affordability, I think only approximately 23% of Americans can afford the average house. So affordability is very, very challenged at the moment. And you've certainly got every incremental purchase has to be done at a far higher interest rate than's been the case for over actually 20 years. So we definitely see that as, housing is a source of wealth, and the wealth effect that brings onto consumer spending and the likes of that. We definitely see that as a potential challenging part of the US economy.
Chad, great to get your perspective there from Talaria Capital. Thanks so much for joining us.
You're welcome. Thank you.
All right, that is the global view on this Wednesday. Just before we go, look, we're a couple minutes away from the local open. That's where we're expected to go. SPI futures off around 0.3%. Stay with us. Open is just around the corner.